everybody. Welcome to your Wednesday edition of the TraderMerlin Show. And we'll definitely talk a lot about the overall equity markets. I'm sure I've already got a bunch of questions talking about these indexes and how we had that nice, tiny little witsy bounce over there. Yes, we'll discuss that, but I'm going to start things off in a much quicker format today just so we can get to our guest. As you guys know, I always encourage you to put your questions down below the YouTube video. If you're watching the archives, that's the best way to get questions answered live on air. Just put them down below the YouTube video. That helps the search engine optimization, apparently. If not, email's on the screen. TraderMerlin@gmail.com is where you can get your questions answered. This question was sent in and decided to make it a full-on topic for today. It's from Elizabeth. Elizabeth sent this one in last night. It says, what is the best way to protect my portfolio using options? I don't want to sell my stocks. I have SPY, IWM, IYR, GLD, and XLU. And I thought, you know what? I can obviously talk about my strategies for that, but I've got a friend who is much more versed at the utility of options and much more versed in the Greeks. And that, my friends, is Mr. Corey Lane. Today we're going to talk about hedging a portfolio using options with Corey Lane. Corey, welcome back to the show, my friend. How you been?
Yo. It sounds like you just said, I got a guy.
I know a guy. We go way back.
Yeah, I love it. Good to see you, buddy.
Good to see you. How you been? Before you say how you been, you've never jammed on those drums behind. Next time, just put the camera on the drum set and just play the drums as like an accompaniment from the show. I think the audience wants to see that.
I think we should try that and see how loud it actually is.
Yeah.
But I'm suspecting it's going to sound like garbage.
All right, we'll do a test run. You and I will do a test run one day. Because that'd be pretty fun. Because then you could like do the rim shot to your own jokes.
For sure, 100% I could do that, and I'm happy to.
All right. Well, what's new in your world before we dive into utilization of options as a hedging tool? Anything new and exciting for you?
Oh man, staying busy, man. TradersArmy's got me busy. Super enjoying all the trading rooms, and we got the summit coming up in 3.5 weeks now here in Anaheim, which is right around the corner from me, and that's going to be outstanding. Killer lineup there, but just buried in making sure that I don't miss a detail, down to decorating the place, and I got a live band coming in and all that fun stuff, and managing a fund is definitely takes up a lot of time as well. So, but I'm enjoying every minute of it.
Nice. Well, I will be there for the cocktail, and if one of your guests bails, let me know and tell me what topic you want, and I'll do something for you.
I'm open to bail if you want to present.
You got a good topic? Let me know. What would the viewers? I guess I could ask my audience. What would encourage you guys to go to an event? What presentation should I give to make you guys excited about that?
Ooh, I like that.
There you go. We'll see what they put. And
I'll watch the chat box over here to know what they're saying.
That's right. And I do have to keep my clothes on, everybody. So that's just keep mine out of the gutter. All right, let's get into hedging. Obviously, yesterday I did a show, I think it was called Market Breakdown in Sight, which doesn't mean we're crashing right now, but things seem to be weakening a little bit. The down moves have been much more aggressive than the up moves, and generally that's a sign of market sentiment. So the down moves are stronger. That would lead one to believe that we might see more downside. So to Elizabeth's question here, which I think is a great one actually, there are some people that have monstrous gains, probably don't want to sell for tax reasons. You can see the question there on your screen, everybody. She's got these 1, 2, 3, 4, 5 positions. How does one utilize options maybe to stay in positions that you don't want to sell and take the tax hit on?
So first of all, if you're long the stock, the most natural position to really look at would be to buy a put option wherever you are willing to or wanting to hedge. So it's the same thing as basically, I bought a house, I built a house, and I want to protect it in case it burns down. So I'm going to buy an insurance policy, and you'll spend some premium on it. But if things go really badly and the house burns down or the stock market drops, then your put option, which is your insurance policy, if you're positioned correctly, would increase as much, at least in value, as you're losing on the stock, which gives you the opportunity to stay in your stock, but still profit from the option if the market drops. Only downside to that is if the market doesn't drop or worse, goes up, you'll obviously lose a little money on that put option, but it's a fixed amount of money tied to whatever premium you pay for the puts. And so ideally, you're buying those options when the storm's not, 18 miles offshore, and everybody knows it's coming. Ideally, the options, when you purchase them, will be a little bit cheaper and volatility is a little bit lower. So if the storm is already approaching and it's already, we're already neck deep in a bear market, then the options will get a little bit more expensive. But nothing is more expensive than losing 50 to 60% of your portfolio. And I would happily buy a slightly overpriced option to hedge that. That's the simplest way to focus on hedging a single stock position. So buy puts on that stock.
And are we doing it to the, because obviously it's not one for one. I mean, if I have 100 shares of SPY, it's not like I just can buy one put for SPY. Really, there's other factors there. Are we looking at it from the perspective of, okay, I've got, let's just say 100 shares of SPY. I need to find the right amount. So let's say the SPY drops 10%, that the puts that I've bought are designed to offset that 10% worth of downside move?
Not one for one, because if you and I know you do, Merlin, but if your listeners out there are not completely familiar with how options work, there's something called the option Greeks. Delta being the main Greek that you're referring to right now, which is going to represent the expected change in the option's value if the stock actually moves in your favor or against you. So if you were to buy an option at the money on SPY and you own 100 shares of SPY, but you were to buy a put option at the money, you'd only get about 50% protection on that. So you're saying I'm going to pay for one contract, I'll have a little premium. If the stock loses $1, I'm going to lose $1 on the stock, but I'm going to make 50 cents on the option. And that's, certainly, 100 shares, one contract seems the most obvious, but, something that I teach quite often in terms of hedging would be the concept of delta hedging. So if you want to hedge 100% of your risk in those 100 shares of SPY, then instead of buying one contract, you buy two with a 50 delta.
Right.
So what happens is when you buy two put contracts, you now have 100 negative deltas that will offset your 100 positive deltas completely. So even if the market goes to zero, you'll actually make way more money on your puts than you would lose on your stock due to the dynamic nature of delta, increasing as the stock drops. So in the sense that you were to delta hedge on the SPY, for instance, or any stock for that matter, 100 deltas long, 100 deltas short, you actually have what looks like a straddle position,
right?
Where if the market goes up, you still have upside potential to infinity. If the market drops, you have profit potential all the way to the market going to zero. And that delta type of hedging is what I personally prefer because I can control exactly what I'm willing to risk on any one position if I'm just using an option to hedge one position.
Sure. And I think one important there, you said you can make a lot more money with the puts than the position itself. I think a lot of it has to do also with the time. I mean, time is a major factor in this one, how long you're buying those puts for. So just to know it's not as simple as just delta itself.
Right. And I'm watching the chat box over here, and there's, a lot of activity over here regarding that. And one of the questions that Big Eb had was, you have to do the math to fully hedge. I don't know if it's a question or a comment, but you have to do the math to fully hedge a position with options. But your options trading platform should make that really easy for you. And certainly, I think if you've ever, watched me on the show with Merlin before, you know that I use a platform called Thinkorswim. A lot of option traders use it. It's got a great built-in analytics that lets us really quickly understand what our delta exposure is.
Yeah, and I think a lot of people don't use platforms. I mean, honestly, come on, you've worked with a lot of traders over the years, and even something as basic as an E-Trade account, people struggle with the functionality of how to use those platforms. So, most people probably aren't as versed, Corey, as you are with the platforms.
Quite possibly, but the math isn't that hard either. I mean,
right.
if you're thinking, hey, I'm going to target this, 50 delta put, and I own 500 shares, then I need to, hedge with 10 puts to get a full hedge.
Right.
So the math is actually quite simple. You don't need the platform. What I like the platform for is when we get into the concept of portfolio beta-weighted hedging.
Ooh, we've gone from delta hedging to portfolio beta-weighted hedging. I'm learning new stuff every day, buddy.
It's actually pretty cool. Something that's really easy to demonstrate should you ever want me to do that. And I mean, I could do that today if you want me to show you that.
I love when you share your screen. I think the viewers would rather see your screen than mine. So.
Okay. Yeah, I'm down to share it. But that's like the topic that I think I I hear the most about. Let me go ahead and share this Thinkorswim here really quick. That's what I usually hear a lot about is I've got not just one stock I want to hedge. What if I want to hedge the whole portfolio? And so, can you see my screen?
Yep,
here?
gotcha. Yep.
Oh, sweet, awesome. Hey, technology, it works.
Woohoo!
So just kind of going off the original example of using something like SPY, what Thinkorswim lets us do is simulate hypothetical positions, right? And so what I like to do is say, okay, let's pretend that you have 100 shares of SPY. So I pull up the analytics platform in Thinkorswim, go to the Analyze tab, and I just smash the ask there, and it shoves 100 shares of SPY down here as a simulated position. You could even go so far as to say, yeah, but I didn't get into SPY right now. I actually got into SPY when it was at 390, just throwing out a number.
Okay.
So I type in that I got into the SPY position long 100 shares at 390. So what this now shows us as the current price of the SPY, which basically landed at 417.27 today. Is that where it landed?
I don't have it up, but I'll bring it up. Yeah, 417.27. Yep.
Yep. And so what I'm looking at here is I'm looking at this. If you can see where my cursor is here, it says $2,727 profit based on where the stock market closed today, or the SPY closed today. This lets you simulate what if the stock went up, what if the stock went down, etc. And so now what I can see here is my position delta. So if I had 200 shares, it would show me my position delta. If I had 830 shares, or not 8,730 shares, but 830 shares, it would show my position delta. And this number is critical because that's the amount of exposure you have to the market dropping. And so if you have a simple 100 shares, just to kind of go back and reiterate something, and you were trying to hedge for, let's say, the next 268 days, all the way out to January of next year. Populate that, come over here, look at an at-the-money option really quick, or even slightly out of the money, and you can see that we've got our delta column. I can't really draw on the screen, or I would. I'm used to using Zoom, so I can draw. But if I were to take this, say, 425 put option that has 49.6 deltas to it, rounded to 50.
Yep.
If I smash the ask, it shoves that one contract down here, and you can see what it did to the net position delta.
Only 48%, right?
Now I just reduced my position delta by 51% roughly, and if I add another one, smash the ask again, I'm about as neutral as you're going to get. And so what that allows us to do is say, okay, that gives me a neutral delta position. But what's really cool about this is if you look at the delta, if the market were to go, say, let's just say it were to go up 20% or down 20%, this would show us that no matter which direction the stock went, whether it went up 20% or down 20%, with this hedge attached, you'd make money in either direction. Because this option, as somebody pointed out in the chat box, is your option delta is not static. It actually increases as the stock moves in your favor, so your delta exposure becomes larger if the stock is dropping, allowing you to make more money on your puts than you're losing on your stock. And if the stock were to go up, which is the right way for the stock but the wrong way for the puts, the stock maintains 100 delta position long, but your puts are actually going to decrease in deltas, and gamma is going to decelerate the speed at which those options lose money. So you'll lose money, but you're going to lose money at a slower rate on your option than you're making on your stocks. And so when I pull up a risk profile on this, this looks like, I always ask my students and my members, what does this risk profile tell us we don't want? Well, we don't want the stock to stay where it's at.
Right.
Right? We do want the stock to go one way or the other. Move. I don't care which direction, just freaking move. And so that's what this risk profile tells us.
Right.
That's hedging one stock.
So your max loss on this essentially would be if it stayed at the exact same price. So it stayed at 417.27. At expiration, you basically just lose all the premium that you paid for the options, but that's it.
Right. That's it. That's it. And I wouldn't disagree with Brendan's last comment. 20% corrections are not worth hedging. In his opinion, just buy the dip, possibly. But how do you know it's going to stop at 20%?
Right. Right.
You know what I mean? How do you know it's going to stop?
A 50% dip started at 10, and then 20,
right.
and 30.
Because if you didn't hedge at an expected 20% drop, you would actually be in a situation where you would lose $5,000 on the stock itself if you didn't hedge at all, watching the stock go back down from today's prices down 20% to 336, which is lower than where this simulation said you bought the stock. And so instead of giving up the almost, the roughly $2,700 profit plus another $5,300, $5,400 in actual losses, freaking buy the put and take a $6,000 profit on a 20% drop in the market, and then sell the puts. Use that money to reinvest at a lower price in the SPY, and that's how you buy the dip. You buy the dip not with your money, you buy the dip with the profit you made on the puts for being a option hedger at that point.
Well, you got a bunch of questions coming through here. You mentioned on this one, you're like 200 and something days out. Is there kind of a magic sweet spot with regards to how far out you go? I mean, I know Brendan was saying, how do you hedge for like the long term, like using leaps and things is probably that option.
Yeah, I mean, it really depends upon what you're trying to hedge against. So right now we're talking about hedging against a market decline. So if you expected the market decline to extend beyond 6 to 9 months, you would plan to own a year's worth of insurance, which is normal in our insurance world. I mean, you buy homeowners insurance for a year, car insurance for a year, things like that. So, 9 months to a year is normal if you're hedging against a kind of a global market decline that you might expect. But if I were trying to hedge against, say, Nikola's earnings next week, then I really would just look to buy an option for maybe a month, 6 weeks. So that the time decay wasn't, overboard, so it wasn't super negative. Because the closer you get to expiration, the more theta decay you're going to experience. So, so if I'm just hedging through an event that I know is happening next week, then I'll just buy a month and hold on to it for a handful of days and then sell it right after the event. So it really depends upon what you're trying to hedge against.
Right. I got to correct you on one thing you said, preparing for Nikola's earnings next week. They're not going to have earnings. It's going to be just straight losses. So
they're not going to have earnings.
Well, look, I mean, if history is any indicator, I'll just go the last 3 earnings. You go back to August, they lost 36 cents per share. You go back to November, they lost 68 cents per share. You go back to February, they lost 39 cents per share. So. Yeah. Pretty sure it's not doing so well. And boy, I tell you what, I'm seeing some pretty nice trends here. There's Nikola. You guys want to look at Lucid? Well, there's another down periscope. I mean, this thing's going to be back at its SPAC price of $10 here shortly. It's at 18 today. And then what was the other one? You got Lucid, and then you have there's a couple other ones that were just tanking right now. Rivian. Look at this bad boy. Wah, wah. I mean, Rivian's IPO strike price is supposed to be 78. First trade is 106. And you're at $31. So if you were patient and waited, you can buy it at less than half of what those initial shareholders got their shares of Rivian at. Anyway, I'm on a rant over here. Sorry, buddy.
50% off. I'll take it.
50, what a deal.
If you loved it at 100, if you liked it at 100, you're going to love it at 30. You sound like a broker now.
Yep, exactly. There it is. By the way, guys, I'm discontinuing the show. I'm going to work for Merrill Lynch.
There you go.
And no, JP Morgan, because I just love Jamie Dimon. He's my hero.
Love it. My hero.
Oh.
Yeah, Brandon asked another question in there, which is, how do you offset the risk of time decay by selling an option? And the answer is yes. You could sell some sort of option series against it, against the put that you're buying. You could sell a call option against the stock that you own. Either way, you're going to bring in some premium to offset some of the time decay.
Yeah, and I think that this isn't to say rush out there and start buying puts on everything, but I think it's a topic that warrants discussion because again, you look at what's gone on in these equity markets, and I'll bring up the chart on my side over here real quick for the viewers. I mean, you look at this run. Even just the run from the 2020 lows is ridiculous. That is definitely due for a bigger pullback. But when you look at the longer term and go back to our 2009 lows, I mean, this is a 14-year unbelievable bull market where the indexes have moved up, at least this one, from those lows to the peak roughly 623%. Yet it's never had a major pullback, and of course a lot of factors pushing this. So, I think it does beg the question of when does one decide to protect their profits a little bit and maybe be a little bit more defensive as opposed to totally offensive. I believe, like Jeff Manson and others, that this market's going higher. I just don't think it's going higher right now. I actually think it's going to go higher in the next 20, 30 years, sure. But over the next couple, 3 or 4 years, I think you're going to have some significant pullbacks. And why not capitalize on those as opposed to let all those gains disappear, as a lot of people will do. So hedging, I think, is a very, very good approach to locking in some profits without necessarily taking in the tax hit.
Yeah, I agree. And that's probably the biggest reason to hedge versus sell is the tax hit and for the upside potential, which is why I like delta hedging, because you still have the upside potential without the downside risk.
So let's do one for Elizabeth. Let's just let's put on XLU, right? XLU has been just gangbusters lately. Just so maybe we can get kind of a more visual example. I mean, you've been very visual examples, but let me bring your chart up. There you go. XLU has just been on fire, especially since those 2009 lows. But really, the COVID lows are where it just has gone absolutely bonkers. Let's say she's got 100 shares of this one. So what would be the approach here to protect this from falling further?
Okay, so let me just mention one thing. The time to protect this is not necessarily when it's coming into a potential area of demand, right? That's like you buy the insurance when the house is 80% burned down. But if you expect a lot further downside, not positive, I do, but if you owned, shares of XLU, let's pretend, and we could ask Liz if she's on here, but let's just pretend that I'm going over and I'm Liz, and I know that I bought, 300 shares of this stock, and let's say that she bought it at the absolute low at 64 on this return to this, little bit of fair value demand area here. Let's say she paid 64.60 for it, right? So I'll type in 64.60. So, when the stock was up at, 77.12, that was the high, 77.12. She was up $3,700. But now that the stock is back down here at 72.65, she's given up about $1,300 worth of profit. Mm-hmm. Now, let's pretend that her concern is, go back to a weekly chart here for a second. Let's pretend that the concern is, oh my gosh, I think the stock's going down to 45 again. It's going to break through this uptrend, which is seemingly getting stronger. Mm-hmm. Also, sign of potential, weakness in the market around the corner. Let's say that she's fearful that the market's going down to 45. So I plug this in and say, what if the market goes to 45? And I don't have any hedge. Well, these 300 shares are going to lose not only all $2,400 she still has in profit, but an additional almost $6,000 in actual risk. And she says, oh, I don't like that at all. That sucks. So again, you go out and you choose your expiration date. Now, your expiration date is basically based upon how long you think this is going to take. And I always give it a few extra months. So how long could it take to get back down to those lows? Well, I mean, last time it did it, it got down there. Now, this is, mind you, a COVID, the COVID collapse, which, took, 1, 2, 3, like 4 weeks, right?
Maybe a month and a half. Yeah.
5 weeks. So that's kind of a short period of time, but that was obviously a pretty big catalyst. So let's say it takes twice as long. Right? 10 weeks, 12 weeks, 13 weeks, whatever it is, 3 times longer, 15 weeks, then you're gonna be fine if you go out and use some December options, right? If you expect it's gonna take, a handful of months to get there, 4, 5, 6 months, you'd be fine using, December. But you could go a little further if you wanted to. So that's what I mean by try and pre-plan and have an idea of, okay, how long would it take to get down there, and then choose the appropriate expiration based on that. Okay. So let's just choose December. And say, okay, well, where do I want to hedge? And here's where you have to ask the question. In the insurance world, your insurance broker is going to ask you, do you want a no deductible scenario or do you want a deductible scenario?
Good analogy.
Right, where you have a higher deductible, you'll have a lower premium. But if you're like, I don't want a deductible, I want to be fully covered, well, you're going to have more premium. So if you want to be fully covered, you got to hedge all 300 long deltas. And so to do that, you look at the current, call it at the money strike. It has some decent open interest. And you say, okay, I'm going to buy one of those 72 puts. And you say, well, one only hedges away 48 of my 300 deltas. So just crank that number up until this delta becomes, call it 0, or close to it, and that means you really don't have much of a deductible. In fact, what you can see here is you have a $10 deductible. That's what that says. I have a $10 deductible to protect my stock going all the way down to 45, where now if you look at this profit and loss situation, this one says you'll make about $7,000 if the market drops to 45 instead of losing $6,000.
Right.
But you've got a $10 deductible. If you're like, yeah, but I got to pay $6.20 for an option times 6 contracts, that's a lot of premium. Well, if you tell your insurance broker that, he's going to say, well, we could increase your deductible to, say, $100, and that is going to protect you less if the market drops, but you'll get away with only having to buy 4 contracts at $6 a piece. And, of course, you won't make as much if the market drops to 45, but you'll still make something. You might say, well, that's still too high a deductible. How do I just make sure I don't lose if the market drops to 45? Well, let's buy a few less, and it looks like 3 contracts means you'll make $500. You're not really going to lose. You're going to lose all your profit, except for $500. But you would not be locking any of your, too much profit in. But if the market dropped to 45, you'd really have about a $500 risk. Now, keep in mind that's if it happens today. So if you were to go out and say, okay, let's consider time decay or theta in this. What if it happens all the way out to September 15th? So this is how I would pre-plan to compensate for theta and say, okay, well, theta is going to take some money away every day. So if I want to make sure that I don't lose very much or any at all, then I need to buy 3 contracts. It gives me a deductible of $160. And at least if the market drops to 45, I'm not really losing money. I'm losing some of my profit, but not really losing all my money.
Yep.
Right. And so there's some moving parts here with the Greeks and obviously using the P&L, but I would not like to try to attempt all of this without an analytics platform. So if you're going to be doing this kind of stuff, it's super helpful if you have an analytics platform that gives you a lot of flexibility like this.
Yeah, well, to go to Margaret's question here, she's like, man, this is too much for me. And you're right. I mean, when you look at options, it's, as Brendan says, it can be one of the most complicated asset classes out there. This is definitely something that's a little bit more complicated. But again, I think it goes back to the old phrase or mantra, or whatever you want to call it, idiom, I think, that repetition's the mother of perfection. And of course, for some of you, you look at this platform here and it's all Greek. No pun intended, because there's a lot of Greeks on the screen. But it might seem completely foreign. But the more you use it, the more clear it becomes. I'm sure if we had Corey on every day this week going over the same thing repeatedly, by Friday, you'd be like, oh, okay, I get it. And then we'd be letting you do it on your own. But unfortunately, we don't do that here. You have to go to Corey and TradersArmy to learn kind of how Corey is implementing this strategy in real time using real markets and real money. So,
yeah. I mean, everything's complicated until you actually get some guidance on it. I mean, walking was complicated for you as a baby. So
I don't remember that. I came straight out of the room running.
I can tell you, you might not remember it, but I can promise you didn't give up no matter how hard it got.
That's true.
I mean, think about how hard it would be. Oh my gosh, this is too much for me. Walking is too much for me. Imagine saying that as a baby. Forget it. You know what I mean?
So I know some people that did do that, actually.
I don't disagree with Margaret saying, oh my gosh, this is very complex. It can be complicated. I agree. But with the right guidance and the right motivation to really learn. I mean, I think if you got your butt kicked in the market dropping 50 to 60%, I think that you would say, you know what, no matter how complicated it is, I have to freaking learn how to do this because I never want to go through that again.
Yeah.
Right. And so that's, unfortunately, some people have to experience the worst case scenario and have to have so much pain that you say, you know what, I wish I would have learned this. And yeah, I mean, everybody has the opportunity to learn it, but it's just if you throw your hands in the air and say this is too complicated, I mean, think about what you would tell your kids if they said anything was too complicated. You would walk them through it. You would talk them through it. You would get the right people in front of them. If you weren't the right person to help them through whatever they were trying to work through. So if that's what you're trying to, figure out is how do I do this? How do I make sense of this? Then just get some guidance, get some education and any sort of mentorship around it. And, the right mentor will make it simple for you.
Absolutely. No, and again, that's why I like showing people, having you on and kind of showing this stuff, because I think part of it is I believe that a lot of people don't understand what you can do with options or even some of these other instruments. So, while this may have been above a lot of people's understanding of options, I think the foundation of the discussion is, how do I protect my portfolio? How can I hedge against market uncertainty? And Brendan asked a great question. He says, or I think Margaret did, like, how do you know that December would be the time? You don't. You come up with an estimate based off of what the charts have done in the past and how have they moved. And, if it seems like there's this cycle that moves in 6 months, then buy 6 months, then use 6 months as your time frame. But, it's not 100%. I think with every asset class that we talk about on this show or you guys talk about in your life, it's always a probability game. And if the odds seem like they're stacking up in favor of a downside move in positions that you own, to Brendan's point, I think you got to ask yourself, well, how far is it going to drop? Is it going to drop 5%? Okay, fine, I'll just look to buy the pullback. But if I'm expecting a much bigger move, 20, 30, 40, 50%, I mean, I think a move of over 50% is coming in the equity markets, but I just don't know when. Probably my guess is going to be next year sometime. That said, how do you protect yourself for that? And I like that what Corey showed here is because you can have varying degrees of protection using the same asset, the same instrument, and saying, okay, well, I just want a little protection. Fine. Or I want to have the full thing covered. Great. We get that flexibility using options, which I think is fantastic, especially for those of you who have long-term gains that you just don't want to sell out of. Now, there was a question that said, aren't you going to pay taxes on the option? Yeah, sure.
Yeah, you will, but maybe not as much as you're going to pay if you sell the stock.
Right.
I have a couple students that I was teaching back when I was traveling and teaching that owned Apple. This one student of mine in Denver owns Apple at $7 when it was called Apple Computer before the 7-to-1 stock split. So now he basically owns about 4,000 shares of Apple at $1. And I mean, where is it trading today?
156.
156. He owns. At the time, he owned 4,000 before the split. Now he owns about 28,000, I guess, if he bought no more at $1 a share. I mean, it was a large position. He said, my wife won't let me sell it. She's married to it. I don't want to take the tax hit. So this is a perfect example of how we can hedge shorter-term pullbacks and not have to pay the taxes on the full, gain from $1 to 150 something, wherever it landed today. And I know another guy who bought IBM at $2. And he's still holding it. It's like some of those you're just going to hold on forever.
Yeah.
And so in order to, kind of not take the big hits when the market pulls back 20, 30, 40, 50%, hedging is the way to go about it.
Right.
And the timing issue is it's not easy. I mean, obviously nobody wants to give up any of their hard-earned money that they made on the stock or any money related to insurance premiums. Nobody wants to do that. I don't want homeowners insurance premiums. I don't want to. I mean, if you think about, if you spend $2,000 a year for the 30 years that you may own that home, I mean, you're spending so much money on insurance that you will probably never use.
Yep.
Right? Health insurance, life insurance, you're probably never going to use it, but it helps you sleep better at night. So, I try to talk people off the ledge as far as like, I don't want to spend that money. What a waste. Well, wait till you hit a 50% drop in the market, and you won't think so. And you'll protect your money at all costs. But looking for evidence, like you said earlier, Merlin, is definitely, look for clues. And we got a big clue in the SPY 4 weeks ago. Looking at the weekly chart here in the SPY, the market could not make a new high and actually ran in to this little bit of area of weekly basing. And once you got a candle that closed, which was the 4-4 candle, once you got a candle that closed below the 328 high wick on top candle that ran right into this basing right after not being able to make a new high, this was strong evidence the market was going to fall, not just to where we're at right now, but quite potentially down, to 381, which is if I'm not mistaken, a monthly area. Yeah, there you go. It's a monthly area. I mean, we could see this thing fall, from that turn. 18%, and that might not be a big deal to some, but it's a big deal to a lot. I mean, I run a fund that we try to not have a drawdown of bigger than 8 to 9%. A lot of hedge funds look to keep their drawdowns under 10% and hedge appropriately.
Yep.
And so if you're willing to take a 20% drop in your portfolio value, okay, that's fine. But how do you know it's going to stop at 20% and not actually make its way down to the COVID lows, which is is this COVID lows? No, it can't be COVID lows.
Yeah, that's COVID lows. Yep.
Holy moly, a 52% drop in the market.
I know.
It's not going to keep going.
And it's not much. I mean, that low doesn't seem that bad. It was only, a year and a half, 2 years ago, and that's off the peak. It's 54%. That's a very logical target.
That's a very logical target for the next turning point. We've got a couple areas to get through. Personally, just looking at the charts, but one of the things that I wanted to share my screen on for a second is, if you have, one stock, that's how you protect it. But, one question that I get is, I don't have just one stock. I have like 8 stocks. I have 18 stocks. I ran into a lady probably 3 years ago that's like, I have 92 stocks that my dad bought over his lifetime, and I inherited them when he passed away, a year ago. And I'm like, holy moly, that's a lot of stocks. Maybe you don't need all that. But if you're looking to hedge a whole portfolio, there's another level of challenge that comes with hedging a whole portfolio, because now you have to ask the question, do I buy puts on every stock that I own, which gets incredibly tedious, incredibly expensive, or can't I just use the SPY if you have a kind of a basket of stocks that maybe mimics the SPY, or maybe you're all super tech heavy and maybe it more mimics the Qs, but you look at what you own, and then you can use one instrument to hedge the whole portfolio. And Merlin, we have about 4 hours left until your show ends, so I'm going to go ahead and no, I'm teasing. But like one really cool thing that I discovered quite a while back is a really neat feature that very few option trading platforms have, which is known as a portfolio beta weighted feature. And the cool thing about this, you ever look into something like this?
I have not, no, but it makes sense. It's a great feature.
This is the cool thing, because like, let's pretend that I don't know. Give me some stocks in the chat box, if you would. Just give me some stocks that you think you might own, and I'll pick a price that you own it at, and I'll build a little simulated portfolio. Right?
There's about a 30-second delay, so it's going to take some time for them to come in. I can throw some symbols out if you want to get started.
Yeah, throw some. I mean, XLU was one that you mentioned, so let's say that Liz owns 300 shares of XLU. Great. What else you got?
Oh, she had IYR.
IYR, fantastic. IYR.
Okay, and those are fairly diversified. Facebook came out with earnings. Let's throw some Facebook in there.
Let's say that there's 150 shares of IYR that she's long, and she was long from 102. Like, really not like that much lower than where we're at today, but 102 even.
And so Brendan says EQX.
EQX, very good. And by the way, if you want to, let's see. Yeah, this was 100 shares. Let's say, since it's such a cheap stock, you own 500 shares of those. And let's say you bought it at, I'm just making prices up, $5.60, right?
All right.
Let's see, what is that, LPG?
LPG, yes. Cheniere.
There we go. Let's say you bought that. Let's say you bought that. You say you own 350 shares, and let's pretend that you bought that at $12.56. Now, here's where you would need to know your cost basis, right? You know your cost basis on the stock. I'm adding that theoretical position as at my original cost basis multiplied by the amount of shares that you own. Let's go with NVIDIA. I'm just going to pick some random ones here. It's a little bit more of expensive stocks. Let's say you own 75 shares of that, and let's say you bought that at $256.30.
Okay.
And let's do one more, FDX. And again, a little bit more of an expensive stock. So let's say you own 85 shares of that, and you bought that at $125.
No, it's trending down. Let's say you bought it at 240. Let's flip it. This one's a loss.
I like it. 240.
Yeah, this is a loser.
A loss on this one. Loser. Okay, great. So this is kind of cool, right? So now what I'm only seeing right now, because I've selected this option to only see a single symbol, is I'm only seeing what I have populated in the ticker bar up here. But if I delete what's in the ticker bar and I put in, say, SPY, well, not /SPY, SPY, and I change this from single symbol to portfolio beta weighted, what this does, and I'm going to hide all my current positions. I don't need to see those. I've got some simulated positions from our options class the other day. But basically, if we take, actually, I'm going to delete all these. Why not?
Oh, I don't mean to make you delete all your work.
Nah, forget it. I'll delete it. I know what I did. I can redo it. These are some of our positions from our trading rooms, and some of them are what we just did right now. So I'm just going to deselect or delete. So let's delete those. Those were today's trades. Halliburton, let's delete that one. We don't need that. This is our IYR. That was a position that we're looking to hedge. And so basically, what I'm looking to do is to make sure that I only have selected the positions that are in your, call it, Fidelity account or whatever account you have. And you have all these stock shares and you want to hedge them. Let's get rid of that XME. That's not part of it. So really, we just have.
And you could just check that. Okay, I see. So you can just check the ones you want. That's kind of cool.
I could uncheck them, but I mean, it's really complicated looking at all these.
Yeah.
So let me just let me just delete. So that way, the only thing we actually see are the shares of the stocks that we just put in.
Peloton, huh? Oof.
Peloton. I don't know how old. See, these are like a bunch of positions. So I'm like, how long ago did that get? Fubo, which is also a dog. That's right up there with Beyond Meat. So I'm just deleting. So right now, okay, so what do we see? We see the positions that we just simulated have. Target, we can get rid of that. That wasn't one of them. So LPG, IYR, FedEx, EQX, XLU, ExxonMobil. Well,
leave it in there. That's fine.
I'll leave it in there. So I'll check ExxonMobil. So right now we have all of these stocks, and we'll say that's what our portfolio looks like. Now, if you were to look at this in a non-beta weighted fashion, you would say I have 500 deltas here. So I'm going to use my big fat calculator here. 500 deltas plus 85 deltas plus 150 deltas, because remember, each delta on a stock share is 1, plus 350 deltas plus 75 deltas plus 500 deltas plus 300, so I'll just add 600. So we have 3,600 total stock deltas, all positive deltas. So if you're thinking, oh my gosh, the whole market's going to fall, I need to hedge 3,600 deltas. No. Now that's the sort of general consensus. But here's the thing: each one of these stocks has a varying beta, which, as most of you probably know, and if you don't, it's the stock's sensitivity to the S&P 500 moving up or down. And so a beta of 1 means that the stock is as sensitive, generally moves as much as the S&P does. If you have a beta on your stock of 2, it's going to move twice as much, historically speaking. It moves twice as much as the S&P does, kind of like a double leveraged ETF.
Right.
If you have a beta of 0.5, it moves half as much. It's not quite as volatile. So every single stock out there is going to have a different beta as compared to the S&P. And so some of these stocks are going to move more than the S&P, and some of them are going to move less. So you really don't need to hedge 3,600 positive deltas. When you look at the portfolio beta weighted version of this, what this does is it mathematically calculates all of the shares of stock you own, and it converts those stock deltas into SPY deltas.
Okay.
It basically, if everything were a beta of 1, then this is how many shares you would actually be controlling, which is quite nice to know that, okay, I don't need to hedge 3,600 deltas. By portfolio beta weighting against the SPY, I only need to hedge 253 deltas. Sorry, is that current price? Yeah, 253 deltas. So now, if I go into the SPY and I add that same option that we were working with at the beginning of your show, let's go at the money and say, okay, I've got 253 total deltas I need to hedge. And let's say that you want to use this slightly out of the money option, the 420s. All right. I click on the ask, and notice how it reduced the delta to 205. And so now I can go back and I can find that SPY put. There it is. And I just crank that number up until that delta equals 0 or close to it. And that is a neutral delta portfolio. So if the whole stock market falls, we all know that most stocks will fall with it. Maybe not everyone, but most of them will. This allows us to say, well, what if the market made a 20% move down or a 20% move up? What does my positive or negative delta situation look like? And what would my P&L look like? And so this is sort of a, if I had an analogy for it, it would be like an umbrella policy for 9 different homes. Some of them may burn down, some of them may not. None of them may burn down. All of them might burn down if they're all in the same neighborhood and right up against a, I don't know, Merlin.
Nature preserve. Nature preserve.
Right over here in Anaheim Hills, backs up to Chino Hills. A lot of fires happen there.
Yeah.
So it's kind of like, this portfolio beta weighting method allows us to get really granular on how much insurance we really need to make sure that we're properly hedged. And we're not hedging any single stock. We're using the SPY to hedge a number of stock positions based upon where you got in and where the market price on those stocks is at now.
Right. That's
Super
awesome.
Cool feature.
And Jill asked earlier, Jill, I think, did this answer your question? She was saying, how do you use this on, market indexes versus individual securities? Well, you would just use them on the ETFs like SPY, et cetera. But this is nice. It's a great way to take your existing portfolio, if it's not in ETFs like the SPY or something, and build out one that is protected using those ETFs. Makes it easier for you. So very awesome feature there.
Super cool.
Corey, we got to wrap up here, but tell me a little bit about your Trader Summit. I know you have a special for our viewers out there today. So I'm over on your Traders Army page, sharing that screen, and you guys can see here. You can see Chuck. You can see Corey. You go to more info about it.
So how do I stop sharing that way? Because can they see yours, or do I need to stop sharing first?
Well, I still see your computer. You need to stop sharing to see your face, but I can see. I'm sharing the screen, so I have Trader Summit up.
I think I stopped sharing there. So yes. So Trader Summit, May 16th, May 17th. Super exciting. I'm loving some of the presenters that we have and the topics, some of which I just blow my mind what some of these guys are going to be speaking on. And what I did is, I tried to bring in some people that, obviously you're maybe familiar with, and some people who you might not be familiar with, probably not familiar with. And generally they're kind of all spread out amongst different asset classes. Some of them run option trading, prop firms, and some of them are platform related. But yeah, so it's in Anaheim. So especially if you live nearby, I'd like to say that you have no excuse. If you have to fly in, obviously, you got some expense there. But hey, who doesn't need a write-off if you're incredibly profitable after watching Merlin for all these years? You got to be making some money there.
You funny.
But yeah. So I see that you just posted the summit link in there. If you just go to TradersArmy.com, you'll find the very top of the menu bar has a link right to the summit. But tickets are $500 for your primary ticket. But what I have for you, Merlin, is Chuck and I talked about it. I'm like, let's do something special. And so if you use the promo code when checking out, Merlin125.
Wow, I got my own name on a promo code now. I feel so special.
I'm not doing this for anybody else, Merlin. It's while you are here, you're hanging out with Merlin. Merlin125 signifies that you get $125 off your $500 ticket. So that brings it down to $375. That is a deeper discount than we've ever had. But I do that, for this, and I've got 10 tickets available at that. So the first 10 will get $125 off. If you're like, I missed the 10, can I still get $100 off at least? I've got a promo code for that. I'll give you. Just email me. Just Corey.Lane@TradersArmy.com. In fact, you can email me for anything, anytime. Merlin, I'm going to put that in the chat box if that's all right with you.
I was actually going to put it on the screen, but that's okay. You can do it too.
That's cool. TradersArmy.com. Make sure I spelled it right. Corey.Lane, TradersArmy.com. And that is not $1.25. That is $125 off of your ticket. Not $1.25, Margaret. No. So, yeah, Tom, I appreciate. Tom, who's a big time listener of you, he's reached out to me already and said, hey, I might have some people who want to go, but Yeah, 10 tickets, $125 off. Merlin, 125 is the discount code. TradersArmy.com/summit. We'll be there. Chuck will be there. It'll be outstanding. Margaret, that would actually drop us below our cost.
Yeah, fortunately, there's cost involved with those big halls and everything and refreshments and all. So there's definitely going to be a price on it.
Yeah, I mean, the event's going to cost us a little bit. But you know what? I'm okay because I miss so much hanging out with people and just being on Zoom. And as much as I like hanging out with you on Skype, I much preferred at Merlin when we were in person.
Agreed. Miss those conferences.
I miss those conferences. I miss the radio show in-house. I miss all that stuff. But, we're going to get together for the first time in 2 years and have a hell of a time. And then your ticket will get you into the evening reception. So I got a live band coming. I've got giveaways. I've got cocktails included. So it's going to be a blast. So we can have some fun, learn some new stuff, learn some new techniques, build some more confidence and stuff, meet some new people and network. So we're excited for it. So May 16th, it's coming up quick. So don't wait too long. And because it's in person, the seating is limited. So hurry up. Don't procrastinate.
Excellent. Hey, Matt, Corey, thank you so much. I appreciate it. Couldn't be a more timely topic talking about protecting your portfolio. I think in the next few weeks we'll see some more breakdowns here. And, if you want to use that I guess, technology or strategies to help protect your portfolio, do so. If you want to know more, go to TradersArmy.com to get more information, not only about their upcoming summit, but classes as well. Corey, thank you so much, my friend. Look forward to seeing you on the 16th or 17th, one of those days.
16th, 17th, both. Why not?
I'll be there for the cocktail party for sure.
There you go.
All right, Corey, thank you.
Thanks, buddy. Appreciate you guys. Bye.
Okay, that was Corey Lane giving us some insights into protecting portfolio. Hopefully you found that interesting. I think it's rather complex. However, watch it again if it's a little over your head. I think you watch it, you'll see clearly, maybe on a big screen, so you can kind of see what he was doing on that. I know some of you watching on your phones makes it a little bit challenging to do so. But all in all, I think there's some great stuff here for hedging a portfolio. That, my friends, was Corey Lane of TradersArmy. All right, I have to run through this because, as Big Eb's probably going to start alerting the crowd to, it is time for a 1 hour show. Here's what happened out there today. I'm just going to bring up some earnings calendar real quick. You had Facebook had pretty decent earnings, and they were up about 14%. They still are up right now, a little bit more than that, about 19% in the after-hour session, which is great. But here's the real dog. It was Boeing. Here, I'll bring up the charts. There's Facebook, and here is your daily of Facebook. So you can see right now trading at 208. So that'd be coming up in this actual area of supply, which is interesting. But check out Boeing. I mean, Boeing just getting absolutely annihilated. Huge volume spike on an earnings announcement. One of our, I think it was actually Patrick. I think it was Patrick who posted on a Twitter feed. You look at this trend line here, and it looks like we've breached the bottom of it. Well, yeah, and you're coming into an area of demand on it, but be careful catching that falling knife. This may not necessarily be the floor for Boeing, but they reported earnings today. You also had PayPal. There was a lot of good earnings announcements, but a lot of negative action. Align Technology down 22%. Ouch on their earnings, and they just barely missed, down about 4.9%. Right now down 20% in that after-hour session. So let's see, what else did I have here for you guys? I want to talk about what's happening tomorrow. Earnings calendar. Here we go. Earnings for the 28th, because today is the 27th. I hope I got the day right. It's going to be another double popcorn trade of the day. For those who know, popcorn trade of the day basically means sit on your hands, watch these stocks I'm going to read off as they announce their earnings announcements, and leave them alone. Don't mess with them. Just leave it alone. Those two reporting tomorrow are going to be monster movers. And remember, Apple and Amazon are in the top 5 of the S&P weighting and the NASDAQ weighting, so it could be a very volatile day. Here's your calendar. Apple and Amazon, Intel, Twitter. Apple, Amazon, and Intel are after market close. So is Roku and Gilead Sciences. But before market opens, you've got Altria, Caterpillar, MasterCard, and Twitter reporting earnings. Should be a very interesting day tomorrow, to be sure. All right, that is pretty much it for today's show. I am going to get out here in under an hour, so neener. I told myself this is going to start to be a half-hour show. I just can't do it. I can't bring myself to do it. It seems like these shows are always just kissing an hour. So, again, thanks, Corey Lane, for coming on. You got the discount code. Merlin125 will get you a nice discount on their tickets to their event. I will not be speaking there, at least not yet. Who knows? but I will be at the event as well. Always just hanging out with some nice friends and traders at that event. Tomorrow, I'm going to have Brandon Wendell on the program, right? Tomorrow's Thursday, so I'm going to have Brandon Wendell tomorrow doing a makeup show for last week. He was busy, so couldn't make it on the program. This week, though, he told me he won't miss tomorrow's show. So if you have questions for Brandon Wendell, put them down below the YouTube video. You can just type them down, whatever you want about this show, guests, whatever you feel like discussing, put it down below the YouTube video for today's show. If not, you can email me at tradermerlin@gmail.com. That said, my friends, thank you very much. I will see all of you tomorrow. Take care.